Per usual, living on this channel for educational purposes only is not intended as financial advice. It's Macro Monday. Let's take a look at some crypto flows from James at CoinShares. We saw positive inflows last week. I'd rather see inflows on down days than outflows, so we'll take it. That's a win. If we look at where we are seeing the inflows, mostly Fidelity. GBTC has cooled off quite a bit, and that's been a win. We've seen some outflows from other providers as well. Obviously, the question everyone has is, will we keep going lower? Will we see 50? Will we see 40? I don't think we're going to see 40. But if we do go lower, at what point do buyers step in or the sellers step in, right? Again, more. That's also a question many people are pondering. I think at this point, a lot of the ETF buyers are probably in it for the longer haul rather than the shorter haul. Looking at the weekly flows, mainly Bitcoin, some ETH, some multi-asset, some Solana as well. Country-wise, no surprise, Germany's weekly flows are the weakest, strongest in the United States. Looking at the bold reports, 30-day cumulative flows, we're still sort of flatlining, right? The gold standard for what we want to see is what we saw in 2020, which was mainly GBTC, continuous flows to aid price. And if anything, there was a bullish divergence here because we saw price flatlining for almost 10 months before moving higher as GBTC was absorbing prices post-halving, post-COVID low. So here we're seeing spiking in 30-day cumulative changes of inflows, but not consistent flows, which is really what we, in my opinion, would rather see what we're seeing there. Looking at the CME basis trade for BTC coming in still around 10%. So some of the inflows at least may be related to that. We're not really seeing a massive jump in futures open interest on the CME. It's always good to just check, because if we see flows without price moving, probably that's attacking the basis trade. On the ETH side of things, as we're getting some news on the Grayscale ETH ETF conversion with no fee, by the way, as well as some Solana ETF applications. The ETH CME basis is less than BTC. It's rising slightly, but still, in my opinion, probably not enough at this point in time to be worthy of actually arbing out. It's only slightly above the risk-free rate relative to the BTC side of things. You've also got the on-chain basis trade with Athena probably cooling off the ETH stuff. For BTC, most of the selling based on price action has been in Asia hours, APAC. You could either read this as liquidity is just poorer during this time period. There's fewer bidders awake, right? It could be, as suggested in the thread here, Chinese miners. If you want to drop price, you would sell in a low liquidity period. You're probably better off getting better prices in US and Euro time zones, but the price agnostic seller seems to not care, so they will get worse prices, as we are even up a little bit today after the selling last night in Asia hours. We're still very much not out of the woods here. This could be a weekly tweezer. That's probably the best case. The Dragonfly from a couple days ago at this point hasn't panned out. We're still below the 200-week moving average, below the cloud. We still have this chart pattern to contend with. So there's still a lot of stuff that we need to deal with here. And if we've got a large seller coming in purposefully, seemingly, in a low liquidity environment, or pushing more coins at a specific time of day, then prices will just continue to go down. I mean, that's how it's going to be. So I would definitely keep that in mind. Before we go any further here, let me mention today's video sponsor, Kraken Pro. Kraken Pro is a complete overhaul of the Kraken trading experience with a one-stop shop for advanced to professional traders. Kraken Pro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to your trading style. You can check out Kraken Pro with the link in the description of this video. Non-investment advice. Crypto trading involves risk of loss. Cryptocurrency services are provided to U.S. and U.S. territory customers by Payward Ventures Inc., PBI, DBA, Kraken. Now, ETH is up a little bit today. Sol, I think, is probably going to be up a little bit today on that news. Let's just take a look. Sol barely up on the rolling 24-hour period. Some meme coins are up. Some stuff is up, some stuff isn't. But there is definitely a little bit of a divergence here between BTC weakness and alt strength a little bit. And the interesting thing is, because of the beta effect, right? BTC really hasn't bounced at all. But on some of these alts, I think Bonk was up like, stuff like this. Bowden. I mean, a lot of this little stuff, small market cap, can have very large intraday bounces if any strength comes back to BTC at all. But I think we're still very much in the wait and see period on the Bitcoin. Looking at the calendar for the week, the big thing, the big data print is going to be CPI on Thursday. That should be slightly down year over year. And then we've got PPI on Friday. Bunch of Fed speak, Powell speaking in front of the House on Wednesday, probably just political grandstanding from most of the interactions, but the market will probably react one way or another on CPI. Most importantly, the Fed funds futures odds here currently pricing in no cuts for the end of this month and at least 2 cuts by the end of the year. Whether or not this is in and around the election or after the election, at this point, I don't think really matters because it looks like Biden is going to stay in no matter what. At least he's going to attempt that, and it's looking more and more like he's going to go down with a ship there. So if Powell comes out in September, starts to cut, November starts to cut, continues to cut, I don't really think it's going to matter. This is after the election, obviously, but point being, Powell probably retiring at the end of the year. Would I want a recession on my watch as a parting gift in my legacy? I would not. So I think they're going to be sensitive to that. They're going to be sensitive to the jobs market. We'll take a look at that. Inflation looks to be somewhat on the decline and somewhat not. So it's a tricky environment here for the Fed where they're almost there on inflation. They're risking an explosive jump in unemployment. And a lot of people are saying, okay, enough with rates where they are. We're clearly seeing cracks in the jobs market. And we don't need to continuously cut, as is suggested here, into 2025, but let's cut once or twice and see what that does to the jobs market, see what that does to the restrictiveness in the ecosystem. This is Citi's forecast, and Citi is forecasting quite a few cuts from September to July 2025. And as is suggested in this thread here, their thinking is probably more along the lines of we start to see recessionary type unemployment here and a trigger of the SOM rule and all that other fun stuff that goes along with that. So this would be cuts from a place of weakness. I don't necessarily think that has to be the case, but it's obviously on everybody's radar, right? If we start cutting because unemployment's out of control, that's not exactly a soft landing. We're also seeing the hiking cycle come to a close. Another reason why, as we're cold starting this engine here, again, on the liquidity cycles, it's going to take a minute to get the easing cycle back into the swing of things. A minute being probably the entire quarter, at least globally, but it looks like hikes for the most part are done. And this is always in the back of everyone's mind, talking about the inversion of the yield curve, talking about when do recessions typically start. So we are in the wheelhouse as far as when you'd expect to see a recession, somewhere between 10 and 18 months after the last Fed hike. And as many people, including the doomers, have been saying probably for almost a year or over a year now, certain parts of the economy are already in the recession camp territory. The country as a whole, I think you'd have a tough time arguing, is in a recession. Looking at Trueflation, we continue to live below 2%, which is good. If we look at the month of June, which would be this upcoming CPI print, we started June at 2.31, according to Trueflation, ended June at 2.06, so another decline on a month-over-month basis or monthly basis in Trueflation. From this point onward, we may need to see a deflationary print in Trueflation to actually get CPI or PCE back down to 2%. In the UK, since March, they've just absolutely crushed on their inflation numbers. And we can agree and disagree on the components of the basket here, but based on the measurements of this one index, we are headed in the right direction and living in the right side of 2% for the US and the UK. Are prices still out of control in many aspects, including services? Absolutely, but it's not 10%, right? It's still horrible, but it's less horrible than it was many months ago. Looking at the nowcast for June, CPI coming in at 3.12. The last print was 3.3, so that would be a month-over-month decline. The current July 8 days in CPI forecast is a month-over-month increase. And this is where things start to get interesting, where many have said it's going to be hard to get down to the last mile if we see CPI, for instance, just sitting at 3%, sitting at 3.2, core PCE, right? All of these components just sort of sitting at a place where the Fed needs to take more time at these rates if they truly want inflation back down. Many other people have suggested, well, they're just going to change the target. They're going to make a band on the target from 2 to 3% or whatever, 2.5 to 3.5, and we're just going to have to live with it. I don't think they'd do that before we got back down to 2%, but they could. They certainly could. And it's early. This could go down, but I would definitely be mindful of that. Now, a lot of the CPI inflation that remains is based on shelter, based on the OER component, based on this 6-month lag, something that we knew we would have trouble burning off because it was lagging on the way in. It's going to be lagging on the way out. This is just the way it's calculated. It's a household survey. It's bizarre. All components of it. It was part of the reason why things were so late when everybody saw the rent data creeping up. But it's still in there. It's still baked in. Whereas everything else outside of shelter has come down pretty considerably. Again, I don't want to paint this as like rose-colored glasses that everything's fine, because it's not. But I don't think it's as bad as 9% based on these calculations, right? We've clearly made progress here over the past couple of years. Auto insurance, still a huge, huge slice. And I can't imagine the hurricane season is going to help that. Looking at other different components of inflation, so this is fertilizer, an index for fertilizer. This would bake itself into food inflation, meat inflation, stuff like that. This is back to the pre-pandemic trend-ish. It's not exactly back to pre-COVID levels, but it's flattened out. It's down considerably from highs. So that has certainly helped. If we look at used car prices, those continue to decline. And I said this on the fertilizer chart months and months ago. This is a head and shoulders all day, right? There was a head and shoulders on used car index as well. So that's still playing out. We are not back to the pre-pandemic trend there, but we are well on our way, headed lower. Looking at gas prices, the big thing this week is the hurricane in the south and Texas, how that's going to affect refineries in that region. We may see more hurricanes. We may see more issues with a dip in supply as we head into the summer months when demand picks up, the driving season picks up for gas. So that may be a price imbalance where we may see an increase going into the election in gas prices. And that certainly won't help inflation. I don't have a chart for it, but we've also got issues in the Red Sea still with shipping and shipping price inflation problems there. Here's the path for Burl. And seeing this graph reminded me that, there's a lot of Bitcoin miners in the South, in Texas, more so on the other side of Texas, more so in Atlanta. So we're not exactly in the path of the Bitcoin miners, but this is a good reminder when we're talking about acts of God. This is what we mean: natural disasters, hurricanes, tornadoes, flooding. We don't want geographic risk of the entire Bitcoin network where we get one event in 1 week and then all of a sudden we lose 25% of the hash rate, right? We do not want that. And just a reminder, another reminder that we need a geographically distributed network outside of, we've got regulatory risks here. We've got state and federal issues, all that fun stuff. But we definitely don't want mining companies like, Marathon, CleanSpark, whoever else getting wiped off the planet, wiped off the map on a hurricane. Now, hopefully the severity of this hurricane is going to decrease significantly as it crosses through the United States. But just a good reminder. Looking at the SPR, let's say, gas prices rise significantly. We could continue to empty the SPR. Here's where it is now. It's down from the highs pretty considerably. I'm of the opinion that we have enough production and capacity that the SPR is less relevant than it was in, say, the 80s, but they are starting to refill it again. They added a bunch of barrels last month, still 42% below the high, but they could continue to drain that if they needed to. Now, I opened this today, the GDP predictions from GDP Now at the Atlanta Fed, and it is not a good look to see this move down below 2%. You're going to see a growing chorus of people talking about stagflation. GDP down, growth down, jobs down, unemployment up, inflation up. I'm no expert, but that sounds like stagflation to me. So we'll see where this ends up and if this course corrects above 2%. But this is starting to look more concerning at a time when we're sort of teetering with the Fed here on whether or not they will begin their easing cycle. Looking at the yield curve quickly, we've seen the front end not really move at all. The belly of the curve has been all over the place. The back end has been pretty wild and violent as well. Still very much inverted, but it's good to see the bear steepener, which is where the long end goes higher. It's good to see that come down since last week. And we're going on 2 years being inverted now, the anniversary coming up here. And this is really everything in one chart. Rates in the purple, still at 5.5, 5.25. Unemployment starting to creep up potentially to the point of no return, aka the Somme rule. And we will see uninversion here eventually. We won't stay inverted forever. And then becomes the true test. If GDP is flat or negative, if the yield curve is uninverted, if unemployment is 5% plus, that is not a good look for the economy, especially going into an election. I'd imagine it's pretty hard for an incumbent to win with those numbers. Jimmy Carter type numbers. Not quite in the inflation front, but food inflation certainly has not gone down on a multi-year basis. But for now, the market's party, right? For now, the market doesn't seem to care. So I'm not in the doomer camp. I'm in the doomer camp when we uninvert. Then I think I go full doomer, but we're not quite there yet. The JOLTS numbers and the hiring numbers have also calmed down a bit. So the jobs market in total has calmed down. It's gone from too many openings to fewer openings to fewer hirings. And so that means wages should also calm down. We're also seeing full-time workers drop out of the employment data. And as this chart suggests, we are not in territory that is historically non-recessionary. We are in recessionary territory based on this data. I think a big problem with all the data is we're just rubber banding between what happened with COVID, the effects after COVID. Now we're just rubber banding back down. Here's continuing jobless claims also creeping higher. So there's plenty of weaknesses to look for in JOLTS and jobless claims outside of just unemployment if the Fed wants to focus on something. Rates as a whole though, look, if you've got a job and you've got a house that's either paid off or you've got a mortgage that's below 4%, you are fat and happy. You are probably never been better because you're getting paid on your cash or you're in the market and you're doing quite well. And this is where this kind of two-tiered economy largely originates. Are you paying the rates or are you getting paid yield relative to the rates, right? So there's a massive arb here for anybody who has locked in a mortgage and is just sitting. Now this has chilled the housing activity as suggested in this graph, but the economic divide of the have and have-nots continues to widen. Looking at liquidity, still no help really from the reverse repo. Most of the excitement and action on the crypto side of things came around Q4 into early Q1, where most of the reverse repo was getting drained. Since then, the reverse repo has been flat, and surprise, guess what's also been flat since this time period? BTC, right? BTC's basically been flat since March. And if we look at the March number, 440 billion. If we look at today's number, 415 billion. So really no change relatively since March. Looking at the US liquidity and global liquidity values, global liquidity in the green up slightly, US liquidity largely ranging. Once we see global liquidity start to break out of that horizontal resistance, I would expect BTC up. I would expect dollar down. I would expect S&P and NASDAQ to continue to go higher. It's just a matter of this little thing called a recession that may or may not be priced in right now, where we will have to see what happens. Here's the dollar at the daily cloud here. I pointed this out last night. Maybe this is a massive head and shoulders. I don't know. It's still in a big range, but if we start to see the dollar weaker below 104, then I'd expect more strength for BTC. Now, the best case for the big seller in Germany or GOX or the miners or whoever, the best case for them is we see some upswell here in demand for BTC, and then they can just offload whatever they want. Price might go nowhere, but price won't go down, right? So this is definitely something to watch into and throughout Q3. Do we see cuts from the Fed? do we see a forecast of cuts, at least from the Fed at the end of this month at the Jackson Hole conference? And then what does that do to DXY? That would be a pretty big level to watch. Just like TLT and TNX, 10-year yield, this chart to me is still just wound up like a coil. This is TLT, but it's inverse TNX essentially. Anything above 96, it's go time. Anything above the diagonal, it's go time. This looks very, very strong. Just as a setup of a chart. It's been down only really since 2020, mid 2020. So this is pre-breakout, but I really, really like how this chart is set up, even though it doesn't make any sense fundamentally because we're issuing so much debt on the long end. Still really like how that's set up. Cross-border capital, Michael Howell also mentions, as far as liquidity, this is China's PBOC 28-day rolling liquidity. Basically been flat here since March. Unsurprisingly, again, what's been flat here? Also BTC. So we really need the liquidity picture to get a little bit brighter to lend a hand to BTC up here. Meanwhile, in legacy land, SPX, QQQ, everything just continuing to print all-time highs. This is the old cup and handle. In 2022, many doomers assumed we were just going straight to zero. The astute technical analysts, such as myself, pointed out the possibility of an inverted head and shoulders down here, pointed out the possibility of a weekly Kumo breakout, cloud stuff, basically, right? That played out, and then we got the cup and handle, and now the cup and handle target, we are in the range quickly here between 540 and 600. So there's certainly a little room higher. Not much, but there's room higher. This looks absolutely absurdly overbought. Huge TK disequilibrium here, price well above both the Tenkan and the Kijun. So I would definitely be careful up here for sure. It's going to be interesting because July is seasonally a very strong month, as a reminder here. So, and you know, something's got to give. Either we just keep cooking to infinity. This is QQQ. Or we go up less fast. It's just going to be hard to pull back. Nothing seems to matter. Geopolitical, political, macro, nothing's mattered. Nothing's mattered at all. Price is still going higher as we're starting to get into the technical resistance zones. Of all the sectors in the S&P, SMH, the semis has been maybe the strongest. Obviously, NVIDIA is in this category. And this as well has reached its logical targets based on the multi-week, multi-year cup and handle that SMH put in 2022 and 2023. So I spent time digging around individual components in SMH, SNCI. I mentioned this for a couple of weeks. It still looks like a great trade to me. To the long side, I don't know realistically if we hit 2,000 on this, it would be wild, but I like the setup. I like a potential trend continuation here. Price closing above the cloud. Again, this may be a fake out, but it still looks good to me. I took the trade today, and I'll add, if we go higher, I wouldn't expect this to move to 2,000 tomorrow, but it looks very good. Contrast that with coin. Coin's still very much stuck in the range, in the cloud. Above 250, this would look better. Into the 240s, it would look better later on, maybe August, September. Doesn't look as bearish as BTC, doesn't look as bearish as most of crypto, but doesn't look as bullish as some of the semi stuff, some of the software stuff that's already breaking out of levels. But it looks okay. You know, it's no SMCI, but it looks okay. It's no Intel, but it looks okay. This is the Intel chart, Adam and Eve down here. Bullish TK cross pending over the next day or two. Potential edge-to-edge move, potential resistance point at 33, right? All this is on the table, but it all points to probably, possibly higher within the next couple of months. And if we're seeing some broadening out in the semis category away from NVIDIA, for whatever reason, if NVIDIA's overbought, if competition is coming in, whatever. You know, I don't think any of that's realistic, but I think some of the catch-up laggards are moving as NVIDIA slows down a little bit. This is AMD, also looks great on the cloud. Chart pattern looks good for a bullish shove higher. Contrasting that with IGV, the software sector, this did have, in my opinion, a pretty strong case for a head and shoulders at the 200-day moving average in June. Unlike BTC so far, right, we are still below the 200-day moving average on BTC, but this is something to watch for. If BTC bullishness comes back, the expectation would be, okay, we run it back turbo, right? We run it back turbo back to 72, but you can't just assume that as we're sitting at the equivalent of 77 in IGV, right? IGV had a dragonfly into a spinning top, pseudo spinning top, and continue to show higher highs, whereas we are just sort of sitting at the lows here. Anyway, IGV also looks very strong, and if this measures to a fully invalidated head and shoulders, it would be basically 100 from 88. It's not going to go there in a straight line, but it does look very strong. Comparing SMH to IGV, it would be interesting if on the ratio, just as it topped in 2003, 2002, this would be a top for the ratio here. Dangerous, dangerous game, but it does look like SMH is clearly on the ratio in a parabolic blow off top potentially against IGV, the software sector. So individual names in IGV that I like. PANW, again, contrast this with any of crypto. Look at this relative to crypto. This is a breath of fresh air. This is clearly on the bullish side of the cloud flipping bullish tomorrow. You've got strength, you've got higher highs, you've got a bullish chart pattern, you've got targets that are higher instead of lower, you've got all-time highs, right? All this looks very good. For bullish continuation, SNPS, look at this trend since 2003. Held above the cloud for most of it, back above the cloud recently, a little bit of a inverted head and shoulders pattern there. Also measures to new highs. Palantir has been a crowd favorite. Decently bullish trend channel. It's shrugged off head and shoulders chart patterns a couple times. So this also looks ready for bullish continuation on the cloud with a bullish breakout there. Datadog, a very stupid name for a company, but again, bullish TK cross, price above cloud, bullish cloud pending in the next couple days. This is the bullish setup you want. Stuff like this, not anything in crypto. Miners have done well today. MSTR is a mystery to me. MSTR looks great relative to BTC, right? WGMI looks great relative to BTC. Based on the trend channel we have for WGMI, I can't imagine it goes much past the red resistance channel there, but it can continue to just consolidate and hold these highs. You know, nothing here looks terribly bearish. Maybe lower time frames, double toppy, but it looks okay. It looks great. It looks completely fine. MSTR, probably be worried about the double top as well. Has not broken below where it should have relative to BTC. I don't think it's worthy of a trade to the long side until either BTC recovers or it's back below the midline of this pitchfork, which we may see into Q4. So anything below 1,000 I like, but up here I think it's still overvalued. So all in all, generally, Indices doing great. There's plenty of trades, plenty of things to do outside of crypto, rather than smashing your head against the keyboard looking for a winner, looking for a trade. Lots of stuff in legacy land that looks great. That's all I have for this one. Like, dislike, comment, share, subscribe, and happy trading.